Somewhere in between? Thank you for watching Cashflow Marco TV. Be sure to like, share, and subscribe. Hit that notification bell. CPI stands for Consumer Price Index. It's one of the biggest market movers. If you're trading Forex or stock, you need to understand what this number means. Not actual number, of course. Today I'm breaking it all down, from how CPI affects monetary policy to the difference between Hawkish and Dovish, to how you can actually trade these releases with confidence. Shall we begin? CPI is a measure of inflation. It determines how prices for everyday goods are rising or falling over time. High CPI may lead to restrictive or contradictory monetary policy, raising rates to cool inflation. Low CPI, this could call for an expansionary policy, cutting rates to stimulate the economy. Somewhere in between, this is neutral policy, a wait-and-see approach. The tone behind these decisions is either hawkish or dovish. Hawkish, fighting inflation, or dovish, supporting growth. Hey, let's break down hawkish and dovish briefly. Central bankers are described as hawkish when they are in support of raising of interest rates to fight inflation, even to the detriment of economic growth and employment. Words to look out for: hawks, tighten, or heating up. Central bankers are described as dovish when they favor economic growth and employment over tightening interest rates. Terms to look for are doves, soften, or cooling down. So how does CPI affect Forex or stocks? You're about to find out. A higher than expected CPI release can cause US dollar to spike as traders price rise and rate hikes. A lower than expected CPI can do the opposite, sending the dollar down. How traders use CPI down. Smart traders prepare in two phases. Before the release, by managing risk and setting alerts. Some use correlated pairs to gain exposure. After the release, waiting for the market initial reaction, then entering on a retracement or a confirmation setup. Currency values are directly correlated to monetary policy. When a central bank signals it will raise interest rates or is hawkish, it attracts foreign capital, straightening the currency. When the stand is dovish, cutting or keeping rates low, the currency tends to weaken. Traders also watch CPI because it influences expectation about the Fed's next move. CPI also affects trade flows and trade balance. Two more key fundamentals that influences currency strength. A strong currency can make exports more expensive and demand abroad, whereas a weaker currency does the opposite. This all feeds into the balance of trade and the GDP. These are high volatility days. Spreads can widen, slippage can occur. But for those who understand CPI, this is also an opportunity. Now I'm going to leave you with 5 practical tips for trading CPI from my ABC Trading Rules book. Do not gamble. Always control your risk, no more than 1% of your account per trade. Wait for a confirmation. Avoid jumping in on the first spot. Know your session. Trade only during your designated session or time window. Use a 1 to 3 risk reward minimum per trade. Lastly, review past CPI reactions to anticipate volatility zones. When you understand fundamentals like CPI and how it shapes monetary policy, you gain a true edge. If this helped you, subscribe for more weekly breakdowns. And grab my ABC Trading Rules book below. Learn how I trade these exact setups with discipline and confidence. If you made it this far in the video, drop a 100 in the comments. Like I always say, I have a lot of value and a little time to share it. Peace, family.